At the beginning of my trading journey, I spent countless hours reading books and watching videos. And during that time, all I wished for was a clear roadmap to help shorten my learning curve. In this video, I'll be sharing a full beginner roadmap that can help you shorten your learning curve. I'll be going over everything from candlesticks that are important to risk management and the system that I trade every single day. And I'll also be sharing useful tips that would help you along the way. Before we begin, I just want you to set the right expectations. Trading will not get you rich overnight. It takes time and effort to see real consistent results. So don't pay attention to anybody selling you a dream that trading is going to make you rich in 6 months. It just doesn't work that way. It takes time. You want to sit back and take notes because I will be covering the charting software and broker I use to execute my trades, candlesticks, how to understand market structure and trend analysis, building a system, basically the system that I use every single day, risk management, and useful tips. I use TradingView and interactive brokers to trade. I use TradingView mainly to watch the market and do my analysis, and I enter my orders in interactive brokers. You do not have to use interactive brokers. There are several brokers available that you can try out and use, and I did you a favor by compiling some of them that I have heard good things about or I have first-hand experience using. Now, these brokers do not sponsor me and they are not paying me. I'm not affiliate for any of these brokers. So just to make that clear. If you trade cryptocurrency, Bybit is a good one that you can check out, and Coinbase as well. I have first-hand experience using Coinbase, so that's why I mentioned it. You also have prop firms that you can use for futures and forex trading. Prop firms are useful when you don't have a lot of capital and you're interested in trading. You can gain access to anywhere from $10,000 to $200,000 by using prop firms, and you just have to pay a small fee of maybe $50 to $100 to do an evaluation, and then you pass the challenge and you gain access to capital. I personally trade my own funds, so I do not use prop firms. If you trade futures, options, and stocks, you can also try out Webull, TradeZero, Robinhood, Moomoo, or Tradeovate. These are good options that you can take a look. Make sure you do your research before committing to any platform. Before you place a trade or read any chart, you need to understand candlesticks, how they form, the strongest ones, when to pay attention to candlesticks. There are 3 types of candlesticks. You have the bullish one, the bearish candlestick, and the neutral candlestick. The bullish one is simply bullish because look at this. Price opens up here, sellers try to push it down, only for buyers to step in and push it higher, but sellers manage to push it lower, but it closes above the opening price. This is what it looks like. The opposite is true for the bearish option, the bearish candlestick, where price opens high and buyers try to push it higher, but sellers step in and push this asset, stock, forex, whatever you're trading, lower, and we close below the opening price. The neutral case is where there were no winners or losers. It opens up, buyers try to push it higher, sellers push it lower, and then buyers step in, and then it's flat. Shows that it's neutral. I'm going to go over my favorite bullish candlesticks and I'll explain why. The order of strength of this candlestick, meaning how powerful they are, go from left to right. This candlestick right here is ranked lower because, as you can see, we have wicks on this candle. It means that sellers at some point were present and trying. You see that it opened up, sellers tried to push it lower, and then it went high, but sellers still managed to close it below the high. Stick number 2 right here is really strong because once it opened, sellers didn't step in at all, and it closed at the highs. Number 3, you're probably wondering, why is this even considered? It's because this candle is very powerful, and it means what happened is that sellers were present and tried to push it lower, but then buyers stepped in and flipped it green, and it closed at the highs, showing that it destroyed the sellers. So that's why it's really strong. It's the strongest one. And when you see it, support or where you're trying to buy, an area of interest, I will cover that in later on in the video. It's a strong sign that buyers are present and trying to push price higher. I would show you my favorite bearish candles as well. Similar to the bullish one I showed, buyers tried to push the price high, but sellers just pushed it lower, and it closed at the lows. It still has wicks, showing that buyers were still present. And then the second one here is strong because, as you can see, there were no buyers present. Once it opened up at the highs, sellers just pushed it down and closed it there. Now you have my favorite one. When you see this candle, when you're trying to sell, it would give you confidence to enter a trade. Again, I will cover my strategy later on in this video, so just stick around. So once this candle opens up, buyers tries to push price higher, but it ends up failing and going lower. Those are my favorite candlesticks, and I just read price based on this foundation that I covered here, using the opening, close, to understand what the candle is telling me at a specific time at an area of interest. You don't need to watch every single candle form and try to memorize 80 patterns. You just need to understand what it's telling you at a specific time, at a specific level or price point. Now, here are like strong bullish formation, just to show you what I explained earlier, right? It doesn't matter what the color of the candle is. As long as you see this strong wick below, it shows strength that buyers did try to push the price up so that it can close at least relatively close to the opening price here. And then you see the strong green candle come and engulf this past two candles. This is a bullish formation that once you see an area of interest where you're trying to buy, I'm calling it area of interest at this point because I have not covered key levels yet. Opposite is true for the bearish formation. You see a candle form at the highs, only for this bearish candle to come and engulf the past two candles, shows that sellers are present. Understanding candlesticks is not enough. You need to understand market structure. Market structure tells you what price is doing at a specific time. I'm going to go over the basics of market structure. Number one, you have in an uptrend, you see price making higher highs and higher lows, going up a staircase. In a downtrend, you would see price making low highs and low lows, going down the stairs. Think of it that way. The third one is consolidation, where you have equal lows and equal highs. Any sustainable trading strategy relies on a clear trend, where you have an uptrend or a downtrend. Some people are able to trade consolidation, but I do not recommend it if you're just starting out. You want a clear trend, you want to see clear direction before taking a trade. Now I'm going to go over a term that you need to understand when you're looking at a trend. When price breaks a higher high and creates a new high, what happens is a break of structure. It means that in that trend, buyers have just pushed price higher to create a new high. So that structure has changed, and it shows that continuation is happening. The opposite is true when you're in a downtrend where you create new lows. It's called a break of structure. Now you know what break of structure is, but you need to know what a change of character is. Change of character just signifies potential reversal. You want to also be alert, because if you're trading a downtrend, it won't always go down forever. There will be a time where trend will reverse, and you want to have an idea when the trend changes or is about to change. There's always a sign. This happens when, this will give you a hint, when price takes out the previous lower high in a downtrend, as you can see in this image here, where price broke above and closed above this previous lower high. That change of character occurred, and as you can see, a reversal happened. Now I'm going to go over time frames. I've explained candlesticks, how they form, market structure, trend analysis, but the thing is, you need to be able to put it all together and understand how to use time frames. This is going to take you a while. I'm not going to explain it now and all of a sudden it's going to click. You're going to have questions, and I want you to be able to ask me questions. So leave comments below if you're not understanding, and you can reach out to me on social media and I can try my best to explain it to you so that you understand it. But the popular time frames that people use to enter and exit trades, like the 1 week time frame and the daily time frame, swing traders that like to hold positions for days and weeks would use these time frames. Then day traders typically would use anything from the 4 hour down to the 15 to do their analysis and plan trades and then enter trades on the 5 minute. I personally use things a little different. I use the 1 week time frame to build my weekly trading plan because I review what happened the past week to see how I can then trade the following week. I have a daily time frame strategy, 1 hour to mark my key levels, and then the 5 minute and the 15 minutes to look for direction, and then I enter my trades on the 1 minute time frame. I have a video breaking down my 5 minute strategy, and I also have a video showing my daily candle strategy. So you can check that out later. Understanding how these time frames are correlated and making sure you do the right analysis so you don't end up taking a low probability trade. Time frame alignment is important. It's going to take you a while to understand it and how to use it and find which time frame works best for you because everybody is different depending on your personality. So this example hopefully would help you understand how to use different time frames to gauge your trade. If you're watching the hourly time frame, which is the 1 hour time frame, and the trend is up, so you have a high that is created here, but then it rejects this level and then we pull back and then we create another high. At this point, this level is your area of interest. Why? Because price was stalled there before, and people that wanted to buy will be waiting for a retest because you don't want to chase the price. You don't want to chase price when it's breaking through the level because it could fail. You wait for price to retest this level. So people that are waiting for price to retest this level on the hourly time frame, when you go down to the 1 minute time frame, it would look like a downtrend because what? Price is pulling back. It's coming back down. But it doesn't mean that all of a sudden you should start selling. No, it just means wait for how price will react at that level, and then you can take the trade, and then you can see continuation as well happening on the hourly time frame. That's just a quick example of how to blend your higher time frame with your lower time frame and to take a trade. This will take time, and I can make a separate video that is dedicated to this concept if people are interested. I'm going to be going over my simple strategy. Why do I trade this strategy? It is simple. It works well when there's a clear trend. So you have to have an uptrend or a downtrend to trade this strategy. And I like to trade liquid assets with so much volume and enough interest in the market. And these are the names that I trade pretty often. It works on futures, crypto, forex, but I mainly trade the New York session and I trade stocks. The system revolves around a clear trend, like I said. So in this example, we have a clear trend where price makes a high and we pull back, form a higher low, and eventually we break this resistance, this level here that we rejected from. Once we break this level with enough displacement and volume and interest showing that buyers are stepping up, I like to wait for the pullback into that level that we previously rejected. I don't chase the breakout. So that's my system. When you have a system, you then build a strategy, then you have setups, and you have set of rules that help you execute every day. I've shown you my system. And the main setups that I trade are the opening range break and retest and the previous day's low and previous day's high retest. I have made videos showing you this 5 minute opening range strategy and the previous day low and high strategy. I will link them in the description so that you can watch them and understand how I trade it. Mainly, I'm just waiting for example in the opening range strategy. I mark out the first 5 minute high and low, and I wait for direction. If we break up to the upside, I look for the retest of that level and take a trade. If we break down, I will also look for the retest and take the trade. That is the gist of the strategy and the setups that I take. You can look at the description for a video that breaks it down in more detail. Now, risk management is very important. Anybody that decides to trade needs to be a professional risk manager. When it comes to risk management, you need to understand that you are putting on risk each time you trade. And as a trader, you need to understand what your win rate is. For example, I tend to fall around the 40% mark when it comes to win rate over a set of 100 plus trades. In a month where like market is trending, everything is setting up right, sometimes you see me fall around this 60% rate. But the point is that you don't need to make money every single time to be profitable. You just need to be right enough times based on your risk to reward ratio to be profitable. So if you have a risk to reward ratio of 1:2, so you're risking $100 to make $200 every time or on average, you only need a 40% win rate to be profitable. And that's what I built my strategy around. Now, if you have a higher risk to reward ratio where you're risking $100 on your trades and you're trying to catch 300, you only need to be right 30% of the time. So you don't need to hold on to losing trades for too long. Remember this, every single trade that you take have one of the following outcomes. You have a small win, big win, small loss, most importantly, or you end break even. What you don't want is a big loss that wipes out all your gains from the previous week because you threw out your risk management approach. So you don't want to plan to take a trade to risk $100 and then you refuse to cut your loss when you're wrong and you end up losing $300 every time you lose a trade. That's what you don't want because you have a hard time to be profitable if your losing trades are always bigger than your winning trades. And it's very important to understand that risk management is not something you joke around with. When you lose a trade, you lose 5%. It takes 5.26% to get back break even. That's why you need to keep your losing trades small. But if you keep holding on to your trades and you lose 30%, for example, you need a 42.86% winner to be able to get back to break even. Even worse, if you continue to hold it and you lose 50% of you will now have to make 100% to be back break even. So you don't want to make your losses big. You want to have them as small as possible. Ideally, anywhere within the 5 to 20% range is okay, but don't let it slip because then it becomes really hard to get back on track. It would affect your state of mind and you would just be close to giving up. Now, I'm going to go over helpful tips to help you stay in this game and to continue your journey on the right path. Tip number 1, before entering a trade, always know your loss. Always have a point of invalidation. What that means is when you're wrong, you know before you enter that if price breaks below $200 on a stock, you are out. You need to have that before you enter. You don't stop loss after you have entered the trade because your emotions could then override your decision making. Always think of risk before your profit or reward. Think of how much can I lose before you think of, oh, I can make $500. Because if you're able to protect your downside, the more to protect the downside, the better you have at becoming profitable and staying profitable. Take profits as per your initial plan. If you have a trading plan where you say you're going to take profit when it hits $10, take profit there. Don't get greedy. When you get greedy, that's when things start to get ugly. You can always exit a trade and look for better entries. Just because you enter the trade and you notice that, oh, this might not work, doesn't mean that you're stuck with it and you have to stay in the trade. You can always exit and look for better entry. Take a maximum of 3 trades per day. Try not to exceed this number. In the beginning, you might be excited and you want to take a lot of trades, but that just reduces the odds of you being profitable. because you're just shooting, trying your best to take 5, 10 plus trades. The more you play, the more chances you could lose money. Each time you take on a trade, you're putting on risk. So try to cap it at 3 trades per day. Because if you lose 2 trades in a row, just know that that day is most likely not your day, and then come back the next day. Do not take trades that are outside of your system. If you're someone that likes to trade pullbacks, break and retest, don't try trading breakouts. Just stick to your system. Don't let anything make you deviate from what you know works. Find one mentor, not 5, not 2. Find one good mentor, stick with. Don't have multiple mentors at the same time. That can be very confusing. Does more harm than good. One strategy and choose one asset. If you're going to trade futures, then just stick to futures. If you're going to trade forex, stick to forex, stocks, futures. Don't be that greedy. Journal your trades so that you can actually identify where you're going wrong and what you can improve. Journaling would help you find good patterns and bad patterns that you're forming. If you constantly average down on your trades, journaling will reveal it. If you're constantly not taking profit at where you plan to take it, or you're entering trades because you feel like, oh, it's going to go up or it's going to go down, if you journal your trades, you'll be able to see patterns and you'll be able to fix them. You also be able to see what works, what strategy pays you the most, and then you double down on trading that strategy because that's what you're seeing to work. And lastly, emotions will never go away, and you just have to learn to build a strong mindset. Everybody lives with emotions. I know people say, oh, you have to control emotions, you have to be a robot. That's not true. You would never figure it out in trading. You're always a student, you're always discovering yourself, and emotions would always be a factor. It's what you do when you feel those emotions that matters. So making sure you're always doing what you plan to do is how you stay alive. That's it for this course. This is a brief introduction. I hope you found value. Thank you for watching. I'll see you on the next one.